In this clip, Larry Williams walks through the core tools he uses to read the market.
First of all, I want to have something that helps me measure trend. So I could use a 50-day moving average, or I just eyeball a chart, say we're in an uptrend or we're in a downtrend, not that complex. Then I will have one, what I would call an overbought or oversold index on my chart. I like to use Williams %R. It's just a really good indicator to tell you we've been rallying too much, we'll probably pull back, or it's now time to be a buyer because we're in the buy zone. Then I want to have an indicator that measures a professional accumulation coming into the marketplace. That could be on balance volume. It could be my POVI, price open interest in volume, or my Williams accumulation distribution formula. And I want to see when buying is coming into a market, supporting price. I also clearly want to look at a seasonal tendency in the market. So I have a seasonal chart, so I can see should my stock or commodity be rallying right now based on the seasonal tendency. Are we weaker or are we stronger now than the seasonal pattern? Obviously that gives me a lot of information about what I should be doing.
Larry Williams is showing a very practical way to think about market analysis. Instead of filling a chart with dozens of indicators, he focuses on a few categories of information that help him understand what the market is doing. First, he wants to identify the trend. This is the basic direction of the market. Are prices generally moving higher or lower? Many traders overcomplicate this step, but the trend can often be recognized simply by observing the structure of the chart or using a basic moving average as a reference. Second, he looks for overbought or oversold conditions. These moments can signal that the market has moved too far in one direction and may be ready for a pullback or reversal. Tools like Williams %R were designed to highlight situations where price may be stretched. Third, he wants to see whether professional money is supporting the move. Indicators related to volume or accumulation attempt to show whether larger participants are entering the market. When buying pressure appears together with a trend, it can strengthen the signal. Finally, he considers seasonality. Some markets behave differently depending on the time of year. Commodities, for example, often move in cycles related to production, demand, or economic patterns. Looking at seasonal tendencies can add useful context to current price movement. What is interesting here is how his analysis is structured. Each tool answers a different question. What is the trend? Is the market stretched? Is professional money participating? And does the seasonal pattern support the move? When analysis is organized in this way, trading becomes less about random signals and more about building a clear framework for decision-making.